There is a number the IRS does not want seniors to know about. Not a tax rate, not a standard reporting threshold. It is a specific figure that triggers an automatic secret report filed with a federal agency most Americans have never heard of, and your bank is legally prohibited from telling you it is happening. 7 bank account moves I am about to walk you through are quietly placing the life savings of millions of retirees directly in the crosshairs. And the single most dangerous move on that list is almost always made with the best intentions. Here is what makes this different from anything your bank has ever told you. For the vast majority of people watching right now, these reports are harmless. They are routine government paperwork that produces no phone call, no knock on the door, no frozen account. The thing that turns a harmless report into a federal criminal case is the decision a retiree makes the moment they find out the rule exists. That one reaction, that single instinct that feels like the smart and careful thing to do, is the move that converts perfectly legal money into a federal investigation. I am going to show you all 7, and I am going to show you exactly what not to do at each one. Every single thing I am covering today is real, it is active, and it is happening to seniors right now in 2026. The last move on this list is responsible for more financial destruction in retirement than the other 6 combined, and almost nobody recognizes it for what it is until the damage is already done. Stay with me through the end, because the final thing I give you costs nothing, takes about 10 minutes, and seals every one of these vulnerabilities closed in a single conversation. Move 1 is the IRS flag that triggers the moment you cross a specific dollar amount, and you need to understand precisely what it does and does not mean before fear causes you to do something far worse. A federal law called the Bank Secrecy Act, which has been in continuous effect since 1970, requires every bank and every credit union operating in the United States to generate and submit a federal report anytime a customer deposits or withdraws more than $10,000 in cash within a single day. That report carries the name Currency Transaction Report. It does not route to the IRS. It routes to a division inside the Treasury Department called the Financial Crimes Enforcement Network. Your bank originates and submits it entirely on their own. You do not sign it, you do not see it, you are not informed when it happens. The institution has 15 days from the date of the transaction to file it and is required to maintain the record for 5 years. This filing occurs millions of times every year across this country, and the overwhelming majority of those reports generate zero follow-up activity. No investigator contacts you, no agency freezes your funds, no audit is triggered. A currency transaction report is not an accusation. It is not evidence of wrongdoing. It is a compliance document. If you receive $14,000 from selling a vehicle, walk into your branch and deposit the entire amount. A report is created and absolutely nothing disrupts your life. Hold that fact firmly in your mind, because what I am about to tell you next is the precise point where retirees walk directly into catastrophic legal exposure. Move 2 carries a federal felony charge, and the people who commit it almost universally believe they are being responsible. The instant most seniors learn about the $10,000 reporting threshold, their mind produces the same solution. Deposit $9,000 instead. Make 2 separate trips. Spread the deposits across several days to stay beneath the line. That deliberate decision to engineer transactions around the reporting threshold has a legal designation. It is called structuring. And under Title 31 of the United States Code, Section 5324, structuring is a federal felony. Not a fine, not a civil penalty, not a warning letter. a federal felony carrying a sentence of up to 5 years in federal prison, and financial penalties of up to $250,000. The government additionally holds the authority to seize the entire amount involved through civil asset forfeiture, a legal process that does not require a criminal conviction or even a formal charge. And here's the element that makes this so devastating for retirees specifically. The law contains no requirement that the money be connected to any illegal activity whatsoever. Every dollar can be clean, legally earned over a lifetime of work, legally inherited from a spouse, legally gifted by your own children, fully documented with a paper trail that goes back decades. None of that matters. If you deliberately broke the deposits into smaller amounts to avoid generating the report, the offense is complete. Federal prosecutors have seized the entire life savings of widows, of retired educators, of people with no criminal history of any kind, solely because their deposit pattern matched the profile the law is designed to catch. The rule that keeps you completely protected is this: deposit the full amount in one transaction and bring documentation showing where the money originated. The moment you begin calculating how to stay beneath a number, you have done the only thing capable of turning honest money into a federal case. Move 3 operates with no minimum amount at all, and it is the surveillance layer most seniors have never been told exists. Sitting alongside the $10,000 currency transaction report is an entirely separate filing called a suspicious activity report. This report has no floor, no minimum transaction size. A bank can submit a suspicious activity report on a deposit of $400, a withdrawal of $200, any dollar figure at all, if the monitoring software analyzing your account determines that the activity deviates from your established behavioral pattern. Federal law makes it a criminal offense for any bank employee to disclose to a customer that such a report has been filed. You can be flagged and reported to federal regulators this week and have no legal avenue to ever find out it occurred. What activates the system is not the size of the transaction. It is the departure from your history. If your account has reflected the same withdrawal pattern for 12 years and you suddenly request a large cash amount to pay a contractor for home repairs, the algorithm registers the deviation immediately. It has no mechanism to understand context. It does not process the fact that you need a new furnace or a roof replacement. It records that your behavior changed and it files the report. The same trigger fires on suspiciously round numbers, on cash deposits that are inconsistent with the income level your bank has on file for you, and on any transaction pattern that resembles what the software is programmed to flag. The single most effective protection is documentation. Bring the paperwork that establishes the origin and purpose of the funds, a signed contractor estimate, a sales receipt, a letter of explanation. When the transaction matches the documentation, the flag closes without escalating. Move 4 is the law behind the senior account freezes you may have been hearing about, and it was written to protect the very people it sometimes traps. In recent years, banks and licensed brokerage firms have been granted statutory authority to place a temporary hold on the account of any customer age 65 or older when the institution suspects that customer may be the target of financial exploitation. The hold period extends up to 15 business days and carries provisions for extension beyond that under certain circumstances. The legislative intent is legitimate. The law exists to interrupt the wire transfer scams, the fake grandchild emergencies, and the predatory financial schemes that can drain a retiree's entire account before any family member or advisor becomes aware. But that same legal authority applies identically to a fully competent, completely clear-headed retiree who walks into a branch to withdraw $25,000 to assist a family member with a home purchase. That person can be directed to a private office, subjected to detailed questioning about the purpose of the withdrawal and whether any outside party influenced the decision. and informed that their own funds are being held while the institution conducts a review. Pushing back at the teller window does not accelerate the process. The move that prevents this from happening is a proactive one. Before any large transaction, contact your branch directly. Ask them to document the anticipated withdrawal and its purpose on your account. Designate a trusted contact person the institution is authorized to reach if questions arise. That one step, made before you walk through the door, is the difference between a 15-day freeze and a 5-minute confirmation. Move 5 is the insurance ceiling that a significant number of seniors are already sitting above without realizing it, and the gap above that line is completely unprotected. The Federal Deposit Insurance Corporation covers deposits held at every insured institution in the United States, but that coverage terminates at $250,000 per depositor, per bank, per ownership category. If your account balance at a single institution exceeds that threshold and that bank fails, every dollar above the limit is uninsured and can be lost permanently. Bank failures are not a historical footnote. In 2023, 3 of the largest institutional collapses in American history occurred within a window of approximately 10 weeks. Every depositor whose balance fell beneath the coverage ceiling was fully protected. Those above it were exposed, and the recovery they ultimately received came from a discretionary federal intervention that no existing law requires to be repeated under any future circumstances. If your deposits at any single bank currently exceed $250,000, distributing the surplus to a second institution or restructuring the accounts across different ownership categories at the same bank returns every dollar to full federal insurance coverage. It requires no fees, no penalties, and no reduction in your access or control over the funds. Move 6 is the account decision that cost retirees more money than any other single mistake on this list, and it is made every day by people trying to do something kind. At some point, a surviving spouse or an aging parent receives advice from a well-meaning family member suggesting they add an adult child to their bank account. The reasoning sounds practical. It creates someone who can assist with monthly bill payments, and it appears to simplify the eventual transfer of funds. What it actually does is legally restructure the ownership of everything in that account from that moment forward. The instant your son or your daughter becomes a joint account holder, that money belongs to them under the law as much as it belongs to you, which means a divorce proceeding involving your child creates a direct legal path into your account. A civil lawsuit against your child, an unresolved federal tax debt, a judgment from a vehicle accident, a personal bankruptcy filing, any of these gives a creditor legal standing to pursue funds you deposited because your child holds legal ownership of them. Any single joint holder carries the unilateral legal right to withdraw the complete balance at any time without notifying any other party, and that authority does not expire and cannot be selectively revoked. Beyond the creditor exposure, a joint account can directly interfere with your eligibility for Medicaid coverage, create reportable gift tax obligations, and silently override the specific distribution instructions written into a will you may have spent considerable time and money preparing. Because joint accounts transfer to the surviving owner by operation of law, regardless of what any estate planning document instructs. The arrangement built to protect your financial future quietly hands it to whoever among the people you love is carrying the most legal and financial risk. Move 7 is the complete solution, and it is the 10-minute action I told you at the start was worth waiting for. Walk into your bank and request a payable on death designation on your account. The industry abbreviates it as POD. Under this structure, you remain the exclusive legal owner of your account for the entirety of your life. Every person you name as a beneficiary has zero access, zero ownership, and zero ability to transact on the account while you are living. No creditor pursuing your children can reach it. No lawsuit filed against a family member touches it. No divorce proceeding can pull it into a settlement. At the moment of your passing, the account transfers immediately and directly to every individual you designated, without entering probate, without a court proceeding, without an attorney, and without delay. It accomplishes precisely what families believe a joint account accomplishes, and it eliminates every single legal vulnerability that comes with joint ownership. It is free to establish. It requires one conversation at your branch. And while you are having that conversation, address the balance question as well. The amount sitting in a standard checking or savings account should represent 3 to 6 months of your actual monthly living expenses. For most retirees, that figure falls somewhere between $15,000 and $25,000. Every dollar held above that number is sitting inside a monitoring system, generating almost no return and losing purchasing power to inflation every single month it remains there. Move the surplus in your name alone into a high-yield savings account currently paying in the range of 4% annually, into Treasury bills or Series 1 savings bonds purchased directly through the federal government at treasurydirect.gov, into certificates of deposit distributed across multiple banks so that every dollar of it remains beneath the federal insurance ceiling. You retain complete ownership, you retain complete access, and you begin earning real returns on money that was previously sitting idle inside a system designed to watch it. Here is the single thread that connects all 7 moves. The currency transaction report threshold exists, and your bank will never explain it to you unprompted. The structuring law makes the most cautious instinct a federal felony. The suspicious activity report system operates on any amount and will never notify you when it activates. The senior account freeze provision can hold your own money for weeks under the stated purpose of protecting you. The FDIC ceiling sits at a number that a large number of retirees have already exceeded without ever verifying. The joint account established out of love is an open legal door for every creditor and court proceeding in your child's future. And the payable on death designation that resolves most of this is sitting at your bank, available at no cost, and no one is going to call you to suggest you ask for it. The system will not reorganize itself in your favor. Your bank will not schedule a meeting to review your exposure. The IRS will not send correspondence explaining which account behaviors are generating federal flags. Everything remains exactly as it is, operating quietly against your interests until the account holder decides to understand it fully and act on it ahead of time. You now have all 7. You know the threshold, you know what never to do when you approach it, and you know the single designation that closes most of the risk in one visit. Every form name, the direct government website, and every resource referenced in this video is listed in the description below. Before you close this, think of one person over 60 who is holding most of their retirement savings in a single account, who added a child to that account because a family member told them it was the straightforward solution, or who has never once considered what the $10,000 threshold means or how their account activity looks to federal monitoring software. Send this to that person, your parent, a sibling, a neighbor, the person from your community who recently lost a spouse and is about to make the joint account mistake because loss makes simple sound like wisdom. The probability is high that at least one of these 7 moves is creating genuine financial risk for someone in your life right now. And one share from you is worth more than anything their bank branch is ever going to volunteer. That is exactly what this channel is here for. See you in the next one.